Franklin India Balanced Advantage Fund. Will this NFO help you achieve your financial goals, or will this NFO delay in achieving your financial goals? Let us evaluate and explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions so that you can reach your financial goals faster and smarter. Before we analyze Franklin India Balanced Advantage Fund, first let us understand what is this Balanced Advantage Fund category, and then let us understand some key features of this particular NFO. And then we will move on to analyzing this NFO. What is Balanced Advantage Fund? Balanced Advantage Fund invests across equities and debt. That means they can invest in stock market and also invest in fixed income securities. They will use dynamic asset allocation as a strategy. That means they can move from equity and debt to equity based on the market outlook. If the market conditions are really attractive for equity investments, valuations are fair or valuations are undervalued, then they'll have higher exposure to equity. If the valuation is overvalued, then they'll have lesser exposure to equity. This is what dynamic asset allocation is all about. So Balanced Advantage Fund invests in equity as well as debt based on the market outlook by dynamically managing the asset allocation. What is the difference between balanced fund and balanced advantage fund? In the balanced fund, there is no dynamic fund management. There is a pre-decided ratio of equity and debt funds. They will simply stick to the pre-decided ratio. Whereas in the balanced advantage fund, there is no pre-decided ratio. The fund manager will change the asset allocation based on the market outlook. If the equity market is expensive, he will have lesser exposure to equity. If the market outlook is looks like valuations are cheap, then he will have higher exposure to equity. That way, dynamic fund management is possible in balanced advantage fund. Whether the dynamic fund management, asset allocation, how far they are going to be successful, that we have to check up. Now we have understood what is balanced advantage fund category. Now is the time to pay attention to some key features of balanced advantage fund, Franklin India Balanced Advantage Fund NFO, before we deep dive and analyze the pros and cons of this NFO. This NFO is open till 30th August 2022. Fund manager is Rajasa Kakulavarapu. The benchmark index is Nifty 50 Hybrid Composite Debt 50/50 Index. Minimum investment is just 5,000 rupees. This comes under hybrid dynamic asset allocation. Exit load is nil after 1 year. Entry load is also nil. What is the investment objective of this fund? As already we have seen, this fund will try to capitalize the potential of the market upside, equity market upside, by increasing the equity exposure. Also try to reduce the downside impact in the portfolio by reducing the equity exposure. They will do this by dynamically managing the portfolio. So obviously this fund will invest both in equity and debt. So this fund can drastically increase or reduce the equity exposure based on the equity market outlook. One important fact is this fund uses market volatility as a growth tool in favor of wealth creation. So this fund is actually a dynamic solution to have right mix of debt and equity. Many times investors get confused to how much to invest in debt and how much to invest in equity. Here, the fund manager shoulders that responsibility of when to invest in equity, when to invest more in fixed income, how much to allocate in equity, how much to allocate in fixed income. That responsibility is shouldered by the fund manager. Okay, now is the time to analyze this NFO, Franklin India Balanced Advantage Fund NFO. What are all the potential advantages of this fund? Let us understand. There is no exit load when you move from one asset to equity asset within the fund. When the fund manager changes the asset allocation within the fund based on the market outlook, no, he will move money from equity to fixed income to equity. For this, there is no exit load, there is no separate tax liability. Whereas if you are managing two different funds, you have got a equity fund and you have got a fixed income fund, and you are rebalancing the assets, right? You are withdrawing some money from equity and putting it in debt, and withdrawing money from debt and putting it in equity based on the market outlook. When you withdraw and reinvest, when you withdraw, there is an exit load and tax liability. So that way, this fund is tax efficient way of doing asset allocation. In this fund, the fund manager, he himself decides when to have higher exposure to equity, when to have lower exposure to equity. So as an investor, you need not monitor the equity market performance and debt market performance and move between assets. It is not necessary for you to do it. So it needs less amount of monitoring comparatively. Because this fund also invests in fixed income, will not invest 100% in equity, this fund will have reduced volatility compared to a diversified equity fund. Because this fund invests both in fixed income and equity, will be less volatile. Because of that, this fund has got the potential to give you stable returns compared to an equity fund. Compared to an equity fund, this fund takes a lesser investment risk because they are not investing 100% in equity. Close to 30-35% will be invested in fixed income also. However, 60 to 65% is predominantly invested in equity. So the predominant asset in the balanced advantage fund portfolio will be equity. By virtue of that, this fund has got a potential to deliver long-term capital appreciation. This long-term capital appreciation will be decent enough, expected to be decent enough to meet inflation and beat inflation in the long run. When I say long run, it should be 7 years plus. What are the potential advantages of this fund? We have looked at it in detail. When we did in-depth analysis on this fund, we also came across few negative observations. That will be the potential demerits. As an investor, you have to pay attention to the risk involved in these schemes also. You should not pay attention to the positive factors. You should not pay attention only to the returns. You should also pay enough attention to threats or risk involved in these funds. In that sense, let us now focus on what are all the potential demerits of this fund. As an investor, you don't have any control over the asset allocation decision. Say, for example, if you are investing separately in equity and separately in fixed income, you have the control over the asset allocation decision. Suppose if you think your goals are long term and you are also very young, you want to take higher equity exposure, then you can change the asset allocation. You can withdraw from fixed income and put it in equity. Similarly, if you think you have got a short term goal or your age has gone up and you have reduced risk-taking capacity, you lost your job because of that, you have got reduced risk-taking capacity, then you can move money from equity and put more money in fixed income. That way, asset allocation decision, you will be able to take it based on your personal situation. This is not possible in a balanced advantage. In the balanced advantage fund, regardless of your personal situation, the fund manager may give higher exposure to equity or lower exposure to equity based on the market outlook. So, balanced advantage fund is not an inside-out asset allocation approach. It is an outside-in asset allocation approach. And different assets cannot be withdrawn separately based on your requirement. What do I mean by that is, say I told you, right, you are investing separately in equity fund and separately investing in fixed income. You have got, say, 6.5 lakhs invested in equity, 3.5 lakhs invested in a fixed income fund. Now you are in need of 2 lakhs to be withdrawn. If market is good, market is at all-time high, you want to reduce your equity exposure, then like in that case, you can withdraw 2 lakhs from equity. If market is not good, something like 2020 March, April kind of situation, market was down by 38%, then in that scenario, you can avoid withdrawing from money from equity. You can invest money, withdraw money from fixed income. That which asset to withdraw, that decision you will be able to. Whereas if you have invested the entire 10 lakhs in the balanced advantage fund and you want to withdraw only 2 lakhs, whenever you withdraw 2 lakhs, it will be withdrawn from the same proportion of asset allocation given in the portfolio. If the portfolio has got 65% allocation in equity and 35% in fixed income, 2 lakhs will be withdrawn in such a way that 65% of 2 lakhs will be from equity, 35% of 2 lakhs will be from fixed income. So that way it will not work in your favor. Being a NFO, this fund is not having a track record. In an existing fund, there will be a track record. When there is a track record, we'll be able to do an in-depth research, a detailed analysis on the track record, how this fund has managed successfully. Especially this fund has to dynamically move from equity to debt, debt to equity, right? During pandemic, are they like dynamically manage the portfolio? During Russia-Ukraine war, how did they dynamically manage their portfolio? All these things we will be able to study and decide how successfully they are able to manage the portfolio. Whereas here, there is no track record. So when there is no track record as an investor, you are forced to take kind of blind risk. There is no portfolio also for this one. Right? Being an NFO, only after the NFO period, all the collected money will be invested and a portfolio will be constructed. In an existing fund, there will be a portfolio. So you know in advance what is the present asset allocation in the balance advantage, how much exposure they have given in equity, how much exposure they have given to fixed income based on the current market outlook. Also, in the equity, what kind of sectoral allocation, what kind of stocks, what kind of capitalization they have given, all those things you will be able to evaluate. Similarly, in fixed income portfolio, you will be able to see what kind of rating these equities have got, what kind of maturity they have, what kind of duration they have, what kind of yield they have. All these things you will be able to analyze and you will be able to select best of the best balanced advantage fund. Whereas this is an NFO, there is no portfolio. Again, you are forced to take a blind risk here. So as an investor, you have to do all the analysis and select funds based on calculated risk. Without doing any analysis and research, if you are simply investing, you are taking blind risk. As an investor, you should prudently take risk. You should not blindly take risk. Calculated risk will help you reduce downside risk and will help you increase margin of safety. So I would strongly suggest you to take only calculated risk and strictly avoid blind risk. Being a balanced advantage fund, even for the 35% of money, which is invested in fixed income security, they will be charging you higher expense ratio similar to equity funds. So if you are dividing and investing it between two funds, one equity fund and one fixed income fund, the overall cost will be lower. Okay, we have analyzed the fund's potential advantage and potential disadvantage. What is the final takeaway? Is this a good fund or a bad fund? Though the balanced advantage fund category claims that they will dynamically move between equity and debt and capture maximum upside and reduce the downside. Doing this regularly, consistently is practically not possible, right? So this is basically a high promise, but it is not possible for most of the investors, fund managers to live up to this promise. And scientifically, static asset allocation is better than dynamic asset allocation. Static asset allocation is you have a fixed ratio of 70% in equity, 30% in fixed income, or whatever the ratio you decide. You invest 70% in a separate equity fund and 30% in fixed income. And when the market crashes or market goes up, when this 70-30 is sizably dislocated in your portfolio, you yourself rebalance it regularly. This will help you achieve buy low and sell high to some extent in your portfolio. So the static asset allocation in your portfolio is much better based on the past history. Then anyhow, if you want to invest in balanced advantage fund for some reasons, in that case, there are existing balanced advantage funds which have a portfolio, have a track record. You can analyze, pick and choose best of the best existing balanced advantage fund instead of this NFO. So select existing balanced advantage funds which has got 7 to 10-year portfolio, 10-year track record, analyze and then choose. If you are very particular about investing in this Franklin India Balanced Advantage Fund, then in that case, you can avoid this NFO period and wait for some more time. Wait for it to reopen, let them build a portfolio, we can analyze the portfolio, let them build like a small time of track record. We can analyze their track record and then you can consider this for your investment. Right. So till such time, it is better to avoid Franklin India Balanced Advantage Fund NFO. You can consider it when it reopens, when it has a portfolio built and has a decent amount of track record. One more thing you need to do before investing in such funds is consulting your financial planner, because your financial planner has your financial roadmap. Where are you financially, where you need to go over a period of time. You want to repay your loans, you want to buy a property, kids' education, your retirement. So to achieve all these major milestones with whatever the cash flow you have got, how you are going to achieve, he only has the plan, he only has the roadmap. For that roadmap, for that financial plan, for your financial goals and investment objectives, whether this fund is suitable to you or not, what kind of role this fund will play in achieving these financial goals, he will check and suitably recommend or ask you to avoid this. Also, as a financial planner, you would have done a risk profile for. He knows what is your risk-taking appetite and what is your risk-taking capacity. Based on that, he will be able to tell you whether this fund is suitable to you or not. Also, one more analysis you can ask from your financial planner, that is the overlap ratio. Because you are going to bring this new fund to your portfolio. Your portfolio already may have few equity funds and direct stocks. Because you are adding this new fund, because of that, the existing portfolio is to have a set of overlap or set of unique stocks and better diversification. Whether the unique stocks are overlap, what is beneficial for your overall portfolio and the long-term wealth creation process, your financial planner will be able to analyze and tell you. When he does that analysis, he will also be able to tell you what kind of allocation or what kind of weightage you need to give for this fund in your portfolio. So please have a sitting with your financial planner before you invest. Hope this 360-degree analysis on this fund has really helped you. If you have any additional questions or if you have any questions on other investment products or any financial decision you want to take to achieve your financial goals, feel free to book a free appointment with our certified financial planners. To book a free appointment with our certified financial planner, I have given a link below this video in the description. I have also given one more link in the description, which is for attending our free webinars. Yes, we regularly organize insightful investment webinars with eminent investment experts from the industry. They share their investment techniques, investment strategies to create long-term wealth. You can attend these webinars, learn these strategies and techniques, and apply these strategies and techniques to your portfolio immediately. So just leave your name and email ID in the webinar registration link. I'll book the seat for the next webinar and send you the invite to your email ID. Hope you like this video. I'll again meet you in yet another useful video. Thank you. Bye-bye.